Giving up your US citizenship? Wow, that is one of the biggest, most final decisions a person can make. It's not just about turning in your passport. We're talking about an irreversible act with some pretty serious financial strings attached. So let's dive into what this really means, especially for American expats. And really, this is the question that sits at the very heart of the issue for thousands of US citizens living all over the world. It's this constant balancing act, right? The benefits of having that citizenship versus the sheer burden of what's called citizenship-based taxation. So here's how we're going to break this all down. We'll start with why people even consider this in the first place. Then we'll get into the single most important financial question you'll have to answer. After that, we'll unpack the infamous exit tax, go through the actual step-by-step process to renounce, and finally, and this is super important, we'll look at some powerful alternatives you might not have even thought of. Okay, so what drives someone to make such a drastic decision? Well, it almost always comes down to one uniquely American policy. That's right. The US is one of only 2 countries on the entire planet that taxes you based on your citizenship, not where you actually live. Think about that for a second. Even if you've lived in London your whole life, if you happen to be a citizen, you have to file a US tax return every single year. And here's the real kicker. This is a filing requirement, even if you owe $0 in tax. For a lot of folks, especially accidental Americans, the complexity and the cost of just staying compliant is the real burden. All right, let's shift gears to the one concept that determines everything about the financial cost of leaving. Your entire financial outcome really hinges on the answer to one simple question. Are you a covered expatriate? This is the official IRS label for people who face the most severe tax consequences. You can kind of think of it as a classification that takes you from a simple paperwork process to a much, much more complicated and potentially expensive one. So how does the IRS decide if you get this covered label? Well, they use 3 specific tests. Now, what's so critical to understand is that you only need to meet one of them, just one, and you're considered covered. Let's walk through each of them. The first one is the net worth test. If your total worldwide assets, and we're talking about everything from your home, investments, retirement accounts, even personal property like art and cars, minus all your debts, are worth more than $2 million, you meet the test. Simple as that. The second one is the tax liability test. Now, this isn't about how much money you make. It's about the actual tax you owed. If your average US income tax bill over the last 5 years was more than this inflation-adjusted amount, which is $206,000 for 2025, then you meet the criteria. But honestly, this one right here, this is the trap that gets most people, the tax compliance test. If you can't swear under penalty of perjury on your final tax form, that's Form 8854, that you've been fully compliant with all your US tax obligations for the past 5 years, you are automatically a covered expatriate. It doesn't matter if your net worth is $10. This is why being totally up to date on your filings is absolutely critical before you even start thinking about renouncing. Okay, so you've figured out your status. What does it actually mean for your wallet? Well, the difference is truly night and day. This slide really lays out the 2 very different paths you can go down. If you are not covered, the process is pretty straightforward. You file your final tax returns, you pay the administrative fee, and you're done. No exit tax. But if you are covered, oh boy, you face a potential exit tax. You might have ongoing US tax obligations even after you're no longer a citizen, and you could create a huge tax headache for any US family or friends you might want to give money to down the line. So what exactly is this exit tax? Well, the IRS basically pretends that you sold all of your assets, everything, the day before you renounced. You then have to pay capital gains tax on the growth, or what they call the unrealized gains of those assets. So for example, if you bought stock for 500 grand and it's now worth 2 million, you've got a $1.5 million unrealized gain that could be subject to tax, even though you haven't actually sold a single share. Now, there is some relief here. The IRS gives you a pretty hefty exclusion, currently $890,000 for 2025. You only pay tax on the gains above that amount. So in that stock example from before, you'd get to subtract this exclusion from your $1.5 million gain before you calculate the tax. It definitely helps, but for those with significant assets, the tax bill can still be substantial. All right, let's say you've weighed all the financial stuff and you've decided this is still the path for you. How do you actually do it? It's a very formal, multi-step process. Step one, and I cannot stress this enough, is to get your taxes in perfect order for the past 5 years. Then you'll need to schedule an appointment at a US embassy or consulate where you will formally renounce under oath and pay the fee. Finally, you have to file your special expatriation statement, which is Form 8854, along with your final US tax return. And this is the fixed price of the procedure itself. No matter who you are or what you're worth, everybody pays this $2,350 administrative fee directly to the State Department. Now, that's completely separate from any professional tax advice fees or, of course, the exit tax itself. Before we wrap this up, let's explore a really crucial question. Given the cost, the complexity, and how permanent this is, are there better options? For many, many people, the answer is a resounding yes. This is the key insight that just changes the entire calculation for so many expats. The assumption is that filing US taxes automatically means paying US taxes. But thanks to some really powerful provisions in the tax code, that's just rarely the case. Two main tools make this possible. The first is the Foreign Earned Income Exclusion, or FEIE, which lets you exclude a huge chunk of your salary, up to $130,000 for 2025, from US tax. And for those in high-tax countries, there's the Foreign Tax Credit, which gives you a dollar-for-dollar credit for taxes you've already paid to your host country. It effectively eliminates any risk of being taxed twice on the same income. So what about that scary third test, the compliance test? If you're behind on your filings because you genuinely didn't know you had to file, the IRS actually has a fantastic amnesty program. It's called the Streamlined Filing Procedures, and it allows you to get caught up on the last 3 years of tax returns and 6 years of foreign bank account reports, those are called FBARs, completely penalty-free. This is the single most powerful tool to avoid becoming a covered expatriate. When you look at the actual numbers, the choice becomes even clearer. The flat fee to renounce is over $2,000. But in contrast, a typical professional package to use that streamlined filing program and get fully compliant is often significantly less. Becoming compliant can literally be the cheaper option. And finally, it's just so critical to remember this point. Renunciation isn't just a financial decision, it's a permanent one. You lose the right to live and work in the US, access to consular protection when you're abroad, and the ability to easily pass citizenship to your children. Once it's done, there's no going back. So the crucial takeaway is this. Before taking that huge, irreversible step of renunciation, it's absolutely essential to understand that for many people, the path of just getting compliant is not only simpler and cheaper, but it also preserves all the rights and opportunities that come with being a US citizen. The choice, in the end, is always yours.